Good afternoon, everybody, and welcome to today's Not-for-Profit Speaker Series webinar. I am Matthew Saha. I lead our not-for-profit industry practice for the firm here out of Charlotte, North Carolina. And I just want to welcome everybody to this, what is our last session of our NFP Speaker Series for the year. Thank you for those of you who have been with us through all 8 sessions as we've rolled those out through 2024. We hope that you have found them valuable and informative to your roles at your organizations. So as we get kicked off on this one, we're going to bring up the slide deck for you for today's update. But today, as we typically do at the end of the year, we focus all things on the NFP tax world. And of course, knowing me, I will have some dad jokes to sprinkle out through the presentation as we get to some of our polling questions. I think we actually have 5 of them today, just to give you an extra opportunity to answer those. So as we get kicked off this afternoon, I want to my first question to you, how many tax accountants does it take to do a tax update webinar? Well, the answer is 3. So I'd love to go ahead and introduce today's speakers, and I'm going to turn it over to Melanie, Max, and Daniel to introduce themselves and just get us started into today's session. So take it away, team. And I love your headshots here too. You guys all have very dramatic poses in these headshots. I love it. So go ahead.
Thank you, Matthew. I will start off. My name is Melanie McPeak, and I am a Managing Director and the Not-for-Profit Tax Leader here at Cherry Becker. And I currently and will most definitely sit in Tampa, Florida, since it is cold down here. So, Daniel?
I'm Daniel Stewart. Worked in public accounting about 20 years, and the vast majority of that has been with nonprofit organizations, both public charities and private foundations. I took a hiatus for about 6 years working in a healthcare network that was still a nonprofit. And I'm here in the lovely state of Iowa.
I'm Max Barlow, manager in the not-for-profit tax practice here at Cherry Becker. I've been working in not-for-profit tax for 7 years. I sit up in Minnesota, so we're dealing with some cold weather and some snow as well. And that's me. So today's agenda for today's presentation, we're going to be touching on form updates and reminders, legislative highlights for the year, what's new with the IRS, and other developments. So I'll be starting us off with form and filing updates. Generally speaking, not much has changed in terms of the actual forms themselves. The 990, 990T, 990PF, 990 Easy, and 4720, as well as all the associated schedules, all stayed substantially the same throughout this round of draft revisions by the IRS. So this is for the most part true in terms of the form instructions as well. Most changes were stylistic or formatting in nature, but we do have a handful of filing updates to share with you. So starting off with the inflation adjustment for Form 990, the failure to file penalties increased slightly with inflation. They increased from $20 to $25 per day. For those organizations whose gross receipts fall below the higher penalty threshold, which also increased this year from $1,208,500 to $1,274,000. The penalties for organizations above that threshold went up from $120 to $125. Touching on energy credits, the IRS announced in October that there is an automatic 6-month extension for organizations filing Form 990T for the sole purpose of making an elective payment election. So that'll be those reporting energy credits and claiming the associated refunds for their new clean energy projects. This applies to taxable years ending anywhere between December 31st, 2023 and November 30th, 2024. So with November 15th already behind us for the calendar year filers, if your organization has energy credits to claim for a fiscal year ending during 2024, the 990T for that claim has been automatically extended. You do not have to file an extension form. Erroneous revocations. So tax-exempt organizations are, as most of you know, subject to automatic revocation of their tax-exempt status if they fail to file the appropriate information return or required notice for 3 years in a row. In April, the IRS provided new procedures to follow in the case of an erroneous revocation of your status. So the specific information that I'm going to touch on just briefly is available in the April 30th IRS EO update. But briefly, if your organization receives a notice of revocation, but you have proof of filing within the 3-year period that is cited within the notice as grounds for the auto revoke, you can contact the IRS Customer Account Services or send your documentation directly to the exempt organization's account unit. There is a dedicated fax number for this issue available in the April 30th EO update. Then if your organization has a ruling or determination letter from the IRS stating that there is no annual filing requirement for the organization and you receive a revocation notice, you can send a copy of your determination letter or ruling plus a written request to be removed from the auto revocation list to the IRS. There's a separate fax line and mailing address for that as well in the April 30th EO update. And then continuous use. So a handful of schedules related to the Form 990 series have been designated as continuous use until further notice, which could imply that guidance in these areas is settled for the moment. So not expecting updates anytime soon to Schedule D, which is asset and liability details, Schedule E, the schedule for educational organizations, Schedule I, which details your grants paid out, Schedule O, which is the schedule for narratives and additional disclosures. They've also cut Schedule O down to just 1 page after this year, rather than the 2 pages that we would duplicate. There's only 1. And then also Schedule R for reporting related organizations. A handful of reminders that we will all find useful. Substantially all original filings of exempt organization returns are required to be filed electronically. So that's your full 990 series, as well as the 1120 POL and the Form 4720, plus extensions with some exceptions, I believe. Amended returns are currently excluded from the overall e-file mandate. But that does mean no more paper filings if we can't get it to go through electronically. There's an e-file help desk that can assist with that process. Some reminders about charitable contributions. Donors and donation recipients are both required to keep records of donations made and received. So a written acknowledgement is required to be sent to donors for any single contribution of $250 or more. A donee must provide a written disclosure to the donor as well if the donor receives goods or services in exchange for a single payment in excess of $75. You can find more detail about these specific requirements in IRS Pub 1771. But a little bit more information here regarding the acknowledgements required. So for cash contributions, when you provide a written acknowledgement, it should include the name of the organization, the amount of the cash contribution, a statement regarding whether or not goods and services were provided in exchange, and a good faith estimate of the goods or services provided if applicable. For non-cash contributions, the written acknowledgement is the same, except that you have to include a description of the non-cash contribution, and you do not include a value disclosure for the non-cash item. For non-cash donations over $500, the donor should prepare and file Form 8283 with that year's tax return. Now, a note for non-cash donations over $5,000, the Form 8283 also has to be signed by the recipient as an acknowledgement of the goods received before the donor can file that form with their tax return that year. And the donee should also receive a copy of the 8283 so they've got a record of the property description. Form 8282 should be filed when a donee sells, exchanges, or disposes of certain charitable deduction property within 3 years of the original donation. And that form should be filed within 125 days of disposing of that item, or 60 days of realizing that you should have filed 8282 and did not. So we've got a few examples of written acknowledgements. I will also note that the AICPA has a very helpful article with some resources, including some templates to assist with drafting your written acknowledgement letters, should you need it. But a handful of examples. Thank you for your cash contribution of $300 that Open Hearts Inc. received on December 1st, 2024. No goods or services were provided in exchange for your contribution. Or in the case of a non-cash item, thank you for your contribution of a used oak baby crib and matching dresser that Helping the Needy Inc. received on March 15th, 2024. No goods or services were provided in exchange for your contribution. So a description of the non-cash item versus value of your cash contribution. A couple more examples. Let's see. Thank you for your cash contribution that Second Chances Inc. received on May 6, 2024. In exchange for your contribution, we gave you a cookbook with an estimated fair market value of $60. And thank you for the purchase of a $200 ticket to the She Can Run annual dinner. The fair market value of the dinner is $75. Therefore, the amount of your charitable contribution is $125. So providing that breakout to the donor of the amount that is charitable versus non-charitable because of the goods and services received in exchange. Another item that we always want to keep in mind these days after 2021 is excess compensation. So the IRS issued final regs in January 2021 stating that nonprofit organizations are subject to an excise tax if it pays more than $1 million to certain covered employees. And covered employees are any current or former employees of a tax-exempt organization who was one of the 5 highest compensated employees during the taxable year or any prior taxable year beginning after December 31st, 2016. So the excess compensation rules apply to all organizations exempt from tax under 501A, certain farmers cooperative organizations, organizations that have income excluded under section 1151, which would be income from public utilities or certain government functions, and political organizations under section 527E1. Once you have determined your list of covered employees for the year, that should be updated and maintained annually so that you can re-examine each year whether your compensation for those individuals is beginning to approach the $1 million threshold and whether you may have a filing requirement under IRC section 4960. Another item that has come up a couple of times this past year has been membership dues. So this is related to Schedule C of the Form 990 for reporting political campaign and lobbying activities. To begin with, lobbying and political expenses are non-deductible to tax-exempt organizations. When a Section 501c4, 5, or 6 organization, so that's a social welfare org, labor and agricultural organization, or a business league, receives member dues, if that organization engages in lobbying or political activity, which many of those types of organizations do, because a portion of those dues received is allocable to non-deductible lobbying and political expenditure, a portion of the dues may be communicated as non-deductible to the members who paid them. So you have a couple of options. The first option is you don't provide notice to the dues paying members, notifying them of the non-deductible portion of their dues, and your organization pays a proxy tax on the non-deductible expenses on Form 990T. In this case, no portion of the member dues is non-deductible to the members because you've paid the proxy tax. The other option is to provide notice to the dues paying members that a portion of their dues is non-deductible, and you tell them the portion that is non-deductible. You keep a record of the total. They don't deduct the lobbying portion of their dues, and then you don't owe proxy tax on the dues that you have already communicated as non-deductible. If the non-deductible dues that you communicate to your members ends up falling short of your total lobbying expenses during the year, the excess would be subject to the proxy tax, or it can be carried forward 1 year. If you then communicate the excess amount to the dues paying members in next year's notice of non-deductible dues. Part 3B of Schedule C should help follow the non-deductible amounts communicated each year and hopefully help generate an estimate of the non-deductible portion of dues for the next year. We also wanted to touch on today an area that we do see some difficulty in separating the contribution portion of fundraising revenue from event gross receipts. So the defining factor here is the quid pro quo element to the exchange. So if an event sponsor or an attendee gives money and receives something in exchange, and this is going back to the acknowledgement letters, then a portion of their payment isn't a charitable contribution. It is instead a payment for whatever it is they received. So items that we tend to see for fundraising breakout purposes would be food, beverages, entertainment, prizes, and similar other items that are going to be included in the ticket price or the sponsor package, depending on the person that we're talking about. So when you send an acknowledgement letter because the amount exceeded one of those thresholds, when you send the acknowledgement letter to your sponsors, you would disclose the items that they received in exchange, saying you received these items valued at X, so only Y portion of your donation is tax deductible as a charitable contribution, and would report that breakout on Schedule G of the Form 990. Obviously, if they don't receive anything in exchange for their sponsorship or their ticket price, then that portion is fully, or that payment is fully charitable contribution. A few other reminders, disaster areas. There were quite a few natural disasters this year, unfortunately. The IRS did issue automatic extensions for many of those designated disaster areas. The two deadlines that we're seeing are February 3rd, 2025 or May 1st, 2025, depending on the area and the time frame when the disaster hit. The IRS has also communicated that there is an exception to tax-exempt organizations from filing Form 4626 to report alternative minimum tax with this year's 990Ts. And And then that last item is touching again on the energy credit reporting and refunds, Form 990T, the elective payment election automatic extension. So I will move now to polling question number 1. What key trends are you seeing in your organization? A, innovation, adaptability, and flexibility. B, increased focus on mission. C, operating efficiencies. Or D, joining forces with other organizations. And while you all send in your answers, I'm going to pass it over to Matthew for another dad joke.
Hey, and before I get into that, just a couple questions that I saw come up related to some of your slides, Max. I think one was if you're doing a luncheon, like a luncheon fundraiser, would that kind of the value of the meal be one of those things you're acknowledging as far as value back to the donor?
Yes, precisely.
Okay, perfect. And then just curious, another person asked about if a volunteer has some unreimbursed expenses that they've incurred as part of their volunteering, is there any responsibility on behalf of the not-for-profit organization to acknowledge that at all? I know that there's some deductibility from a personal standpoint on that, but wasn't sure if the organization has any requirement to acknowledge the fact that they incurred some costs to volunteer.
I haven't personally run into that. Melanie or Daniel?
So that's actually a very good question to pose. Unfortunately, I don't have a response for
Okay.
it right now, but I am happy to look into it and get back to the participant.
Okay, we'll look into that. Just email us if that question is yours. And then, yeah, so question for you guys. How does Santa account for the value of his sleigh? He uses net present value. Present. I love a good pun. So back to you guys. I'll let you close out this poll.
Oh, I just lost the polling question.
It looks like the top rated answer was operating efficiencies with 48%, followed by innovation, adaptability, and increased focus on mission. We're pretty closely tied with one another, 25% and 21% respectively. And then joining forces with other organizations was the least amount of people at that, just 6%.
Thank you, Matthew. I'll pass it over to Daniel.
Got to come off mute, Dan.
Yep, gotcha. Thank you very much, Max. That was very informative. Probably have a hard time filling up with that. My intention is the legislative highlights, and there hasn't really been a lot of legislative effort election year, and with the new election or new administration coming in, this is a very big gray area. But for the moment, we still have the Secure Air Act, our Secure Act 2.0, and they have expanded the cap on qualified charitable deductions from IRAs. There is actually a great deal of activity in IRAs, Roth IRAs, and that's something to be planned for with fundraising efforts. Next. FinCEN reporting.
So Daniel,
Generally,
I'm happy to take this slide. And as
yes,
you have
please. This is
as
awkward.
as you have heard recently from both Max and Daniel, there aren't very many updates to report on yet. However, something actually dropped within this reporting requirement yesterday. So very timely for this webcast. Now, tax-exempt organizations are exempt from these filings, but a question has been raised throughout the practitioner community of how does this reporting requirement translate to those entities just set up and haven't received approval from the IRS yet? So they're in that limbo stage. The suggestion here is not to file the beneficial ownership information report, since all exempt organizations have the option to self-declare as a 501c4 status. And since a 501c4 is an exempt organization, the exemption to file lies within. But the recent update from the Texas federal court claims that this filing is unconstitutional and has therefore issued an injunction that spans federally. So even though the deadline for your FinCEN reporting for any for-profit subsidiaries is set at January 1st, there are extensions for disaster areas, but that January 1st deadline may not come to fruition. So please contact your legal advisors or those professionals helping with this type of reporting for further assistance, because this is definitely a developing area.
Thank you, Melanie. We are still waiting on proposed regulations. Final regulations are hard to come by these days. And we should be able to touch on some of the reasons for that here later in the presentation. Donor advised funds since 2008 have been a really big, 2006 properly, target. And the detail they continue to develop in these proposed regulations are clearly something if you have donors who want to organize themselves in these donors advised fund classifications, these rules are still very much in a active area. Can we skip along? Well, how should we file Form 990, 990Z, or 990PF, 990T, anything within the 990 forms, the world we live in?
Yes.
As Max discussed earlier, we are 100% e-file. So pick your
whichever option. There's no all of the above I saw, so no choice for that. But while we have people responding to those, and a reminder, you need to respond to at least 3 of the polling questions to get CPE credit. So we'll leave this up for just a moment. Click on one of those, and I guarantee you will have the right answer. But while we're doing that, another question for you guys. How did the controller stay so cool, calm, and collected all the time? She had very strong internal controls. All right. And I'll do one more for you, I guess. What is the pinnacle, considered the pinnacle of a great tax accountant's career? And they have a tax loophole named after them. So I don't know if one day we're going to have the Daniel Stewart tax loophole, but perhaps that's in the future. So. And look, everybody got the question right too. 100%. It's the first time I've seen that. So thank you to those.
Okay. Next segment here we're looking at is what the IRS is developing and planning for, which of course with the new administration could change. But they have been very active with the resources they've been given. And there is always the dirty dozen scams. Employee retention credit claims, those continually be, you know, their organizations poaching and proposing fraudulent interpretation. So you always look at a retention claim outreach to a distinct level of skeptivity. It's your real accounting firms will handle it properly, but they have just come across everywhere. Phishing and smishing. These are a lot of continuing, but more sophisticated elements of electronic scams. And I had personally received, several of them and know several clients who've had to deal with these. It's something to stay in touch with. This is one of those presentations the IRS gives out that is very useful. The unscrupulous tax return preparers is a thing. Not that, yeah. These are just the the easy ones they're throwing out, and they are mostly easily identified as something that just, if it feels wrong, don't roll with it. Contact your tax professional, contact us, and we'll give you an idea of whether it has any value. Next, please. GE division update is something I'm personally very fond of. It gives us an insight on what the IRS is doing moving into the next year, where their focus is, the things that they are targeting, if you will. There hasn't been a substantial level of change on these in the past 10 years, say, but for 2025, this is what we've looked at. They have increased their funding. They've used the Inflation Reduction Act funding increase to hire new agents, more foots on the ground. And as has come about just through feelers, those agents aren't green and unknowing. These are people they targeted specifically, Big Four CPA candidates and high-level tax law, firm candidates. And so these are people with knowledge, so that could make things easier moving forward to speed things along, or they could determine to be more stringent. But that is notable. We have a new personnel level, and my guess would be they will take it more professionally and move things forward. Priority areas, we still have the clean energy credits, employee retention credits. These have been in play for quite a while, but given the level of potential abuse with them, are still top frame targets. If you have those that you've received, there's still exposure just for examination. And that's not alarming necessarily. It's just something to be aware of. Tax-exempt hospitals, particularly, are continually under attack. Senator Grassley here in Iowa, they re-upped their declaration for the Attorney General to investigate, tax exempt hospitals for their compliance with 501R. Tax exempt collectives utilizing name, image, and likeness. This is so new. We don't know where this is going to last. I doubt highly there's a lot of that going on. So we talked about the compliance with 501R. Worker classifications is continually an issue. It's not, it's a matter of paying attention to the circumstances. And, who is an employee? How much control do you have over said employee, and so forth. 401k plans are a continued element of, and IRA plans as well. Focus of targets. It's there's no great deal. This is something they're looking at. A new initiative, relatively new, is the 990N filers and whether they should have been filing a 990N versus something else. And we have a duplicate there, so let's skip along. 2025 is an interesting year to look at. Are the IRS initiatives for streamlining and being more proactive are still in effect, and this is the year they were developing them in 2024. And now is when we should start seeing the impact in 2025. More manpower, better taxpayer experience, quicker phone response times, faster resolution on issues, be that determinations or penalty abatements. This is all a target of boosting the manpower so that we can get the IRS customer service level at a more acceptable level, something far more responsive. Next. General overview with some statistics. Total number of returns this year, 1,789,000. That's up roughly 10 to 12%. UBI collections 1.9, that's fairly stable. Examinations of tax exempt organizations, that is also fairly stable, but it's creeping up, and it's just something to be aware of with hospitals and other organizations, that there's still a target painted there. Largest amount of organizations filing are California, Texas, Florida, and East Coast. That has not changed in several years. So the exempt deal. Okay. Thank you. They are moving better and faster and more efficiently with exempt applications. That will progress through 2025. 2024, the beginning area was very slow. And thanks to the increase in manpower, they've gotten things moving better.
Thank you, Daniel. I was stuck there for a second, so apologize for the delay. I do want to touch upon the ERC claims. We are starting to see movement in a positive direction with some of our clients receiving the refunds. So that is always good news going into possibly a new calendar year or within a fiscal year end. A question in the chat about IRS guidance around the accounting of these claims. There is no guidance per se from the IRS, so it would be more of an accounting guidance factor. I've seen reporting on the Form 990 on Part 8 of the revenue section, either as other income or even as contributions. So federal grant reporting. And I chuckled one time when presenting to a board. They actually listed out on Schedule B the Internal Revenue Service is a donor, and then the amount of the ERC credit that was received. And it's the proper reporting. And the board got a chuckle as well, saying that the IRS finally paid them for matters that, they owed. But let's move forward with the exempt hospitals. So, for all of the hospitals that are on the line, you are a target once again. Senators Grassley and Warren are urging the IRS to continue to deeply evaluate and increase oversight into our 501c3 hospitals to ensure that they are operating and contributing to the required community benefit, as well as operating in compliance with the newly instated 501R requirements. So focus areas in the senator's inquiry include, again, community benefit, and more specifically, financial assistance policies. So those systems that are reporting either no or very little community benefit are being examined. If you are one of those systems, please consult your tax advisor to see how to improve that community benefit percentage. States continuously attempt to tax hospitals as well based on their community benefit spendings and actions. So if you are if you are a hospital entity or part of a system that is not meeting the required obligation to provide care to the most vulnerable patients, it may be time to thoroughly review processes, policies, and procedures to negate an IRS visit. And the best approach that I have seen taken with exempt hospitals is simply do a mock IRS audit. Really deep dive into the regulations and make sure that these systems, policies, procedures in place within the hospitals are in compliance of those regulations. And here again, let's be wary of the NIL collectives. So the fate of the NIL collective is in the hands of the IRS. While applications for tax exemption continue to be approved for NILs, the question as to whether such an activity is in fact within the exempt entity regulations within the IRS. So are these NIL collectives performing, operating as if they were a tax exempt entity? And normally, tax exempt organizations are not to benefit any person or persons privately, which is essentially what is happening with these NIL collectives. The IRS found that efforts to support community service or charitable causes within the NIL collective organizations are insufficient to outweigh the private benefits provided to the athletes. As this is a newly developing topic within the educational organization space, it may be short-lived as smarter enforcement surrounding the NIL collectives is a priority for the IRS for the upcoming 2025 fiscal year, as Daniel has mentioned. Yet these priorities may not come to fruition if the new presidential administration cuts resources of the IRS, which has been noted in multiple sources. So it's difficult to know what the future holds for these collectives, but they are on the IRS's radar. And again, additional inflation adjustments. We mentioned the 2024 qualified charitable distributions. Those allowances are up $5,000 from last year. So anyone wishing to contribute to your organization out of an IRA can contribute up to $105,000 for the 2024 tax year. Additional adjustments are likely to be made within the 2024 Form 990 series instructions, similar to prior year adjustments. So just make sure to notate that. And the adjustments we're talking about here include, penalty inflation adjustments, some of those negative consequences, but it is important to note. And again, we have briefly discussed IRS exams and some of the red flags that could trigger either a review or an audit. And this slide lists additional areas that could raise concern and trigger further review by the IRS. So examples include, related party issues. That's a big one that we're beginning to see movement on from a practitioner standpoint. Abatement requests or refund claims are triggers for an IRS exam. And it's important to mention the difference between a compliance review versus a full-blown audit. So if you receive a compliance review, go ahead, Max, go ahead and forward that. If you receive a compliance review or an IDR, so an information document request, make sure you have a tax professional in your corner and partner with them to respond to such a review. Now, a review is not a full-blown audit, so any of the documents requested should be just those documents sent to an IRS agent for verification that the information reported on your 990 or other forms complies, and you have the supporting documents to support those filings. Now, an audit is obviously a deep dive review into not only documentation, but processes and procedures. And an audit lasts much, much longer than a compliance review and lasts until a closing letter is issued. So again, it's always important to have a professional in your corner assisting you with any type of IRS correspondence to make sure that the information requested is appropriate for what they're reviewing, as well as an educational backing for agents in case the agents haven't been trained properly or in depth on the matter that they are in fact reviewing. And I always like to announce, some of the cases and the history and the closures within the IRS. So in 2024, 3,200 cases were opened by the IRS within the tax-exempt organization space. Of those 3,200, 1,950 were closed, but they resulted in a 75% change rate. So you think change rate would mean additional tax assessed, possibly for their 990T filings or their Form 4720 excise tax filings, but it could also mean penalties associated with informational reportings, so your W-2s and your 1099s. In addition, 200 compliance checks were closed in 2024, and again, with a 65% change rate. So the IRS is keeping a close eye on tax-exempt organizations, making sure they're in compliance with not only their mission, but also other reporting requirements of the IRS. We have polling question number 3. So which potential nonprofit tax trap concerns you the most? I feel that's more of a Halloween themed poll versus a, happy holiday season poll.
Well, that's okay, because I have some continued themed dad jokes while people answer that polling question. So, what do you call an accountant that has an opinion? An auditor, like me, because we issue the audit opinions, right? So, hilarious
I
one
was
there.
gonna say auditor, but you
There you go.
beat me
You
to
were
it.
on the right. You were on the right one. I'll let you guys wrap up this polling question so that people can get to the final one.
So the most concerning tax trap is unrelated business income as reported by the audience. There are a number of ways to detect unrelated business income. Obviously, you have the three tests right up front. Is it a trade or business? Is it unrelated to your exempt purpose? And then is there a profit motive? Now, obviously, most 990T filings will carry some sort of loss aspect. But those are the three general rules to determine just on the surface whether an activity is in fact subject to the unrelated business income tax rules. Now, of course, the tax code is full of exceptions. So there's always exception upon exception upon exception to those three rules, but that's a great starting point.
All right,
And poll number
final
4.
polling question. Yeah, so, well, people answer this. If they need any help, and of course, we will be happy to follow up with you. Have you heard this one about the lady who landed in the hospital? The doctor told her, "Oh my, we only have 6 months to live." She says, "Oh, that's terrible. Is there anything we can do about it?" The doctor says, "Yeah, you might want to consider marrying an accountant." She said, "Why? Will that make me live longer?" I said, "No, but it'll seem like a heck of a lot longer." So,
Ouch.
yeah, it's a little poking fun at us a little bit there. So hopefully no one takes offense. We're all accountants here, so. We'll let you close that poll out.
There's actually a great question in the chat that just came through since we have a few minutes. Are nonprofits able to create accounts with the IRS? So Max or Daniel, I know there's e-services for tax professionals that can kind of, and I'll say quote unquote, spy on tax payments or possibly correspondence activity. But are either of you able to answer this question?
To my knowledge, an officer of an organization can create a IRS.me account as an officer or representative of a corporate entity and have the same access as far as, transcripts of accounts and, basic fundamental filings that we do. It's just doesn't require 2848. So I was looking at this just the other day. So, but no, I don't think there's a problem with governing individual linking themselves to access of a nonprofit organization.
Excellent. So that's the increased funding that the IRS has received in order to implement some of these additional and more enhanced technology avenues for taxpayers, whether it be individuals, businesses, or nonprofits, to access their information.
Yes, that tails back into not including the increased funding for actual feet on the ground agents. They are leaning heavily into tech, automation, solutions, and that will turn out how it turns out. But those are the two areas they're really driving to increase performance.
And I know the practitioner community is heavily involved with recommendations based on client recommendations, obviously, of, what do tax exempt organizations want to see from the IRS in regards to some of the information that the IRS holds on their organization. So it's nice that we have a very strong partnership with the TEGE division leader as an exempt, practitioner community. So any recommendations that the participants on the phone have for better IRS taxpayer, collaboration enhancements to make to systems, feel free to, reach out to any member here on the webcast, and we could get in touch with the group that can then put that suggestion within the IRS's ear.
Speaking of getting in touch with us, Max, if you go to the next slide, I think you've got the contact information for all three of our speakers today. So feel free to take a screenshot of that real quick if you need to capture that. As a reminder, the recording of this will be posted to our website. We usually get that up within about a week of the live version of the webinar, so it will be out there for you to reference any of these slides. But again, thanks everyone for joining this last session of our 2024 NFP Speaker Series. Really appreciate those of you that have been with us throughout the entire year. And please feel free to reach out with any sessions you'd like to see for 2025, if there are particular topics. Maybe we do a whole one on how to create a IRS account for organizations so we can help people figure out that situation. So if you have ideas, thoughts, feedback, please send those to us or to me directly, and I will be happy to incorporate that into our planning for the 2025 season. And with that, I think we'll close out our webinar session for today. Thank you for everyone for joining, and thank you to Melanie, Daniel, and Maxwell for presenting on today's topic. Hope everyone has a great afternoon and an enjoyable rest of the week ahead. So take care.